Types of traders. Scalper versus day trader versus swing trader versus investor. Which one are you? Today, we're breaking down one of the most important things every trader must understand before choosing a strategy. The four main types of market participants: scalpers, day traders, swing traders, and investors. By the end of this video, you'll know exactly which style matches your personality, your risk appetite, and your lifestyle. So let's dive right in. 1. Scalper, the high-speed trader. Who is a scalper? A scalper is someone who aims to make small profits from tiny price movements, usually within seconds or minutes. Typical time frame: 1 minute to 5 minute charts. Holds trades for seconds to a few minutes. Trading frequency: dozens to hundreds of trades per day. Goal: capture small, consistent profits, 5 pips to 10 pips. Small but repeated many times. You should be a scalper if you love fast decision making. You can handle pressure. You want quick results. You can stay focused for long sessions. Challenges: emotionally demanding. Requires fast internet and low spreads. One mistake can wipe several wins. Scalping is like sprinting. Fast, intense, and requires high discipline. 2. Day trader, the in and out expert. Next we have the day trader, someone who enters and exits trades within the same day. Typical time frame: 5 minute to 1 hour charts. Trade duration: minutes to a few hours, no positions held overnight. Trading frequency: 1 to 10 trades per day. Goal: catch the daily price move, the New York session push, London breakout, etc. You should be a day trader if you want more time to analyze. You prefer a structured daily routine. You don't want overnight risk. You can manage emotions better than scalpers. Challenges: still require strong focus. News events can destroy setups. Overtrading temptation. Day trading is like a middle distance run. Fast but not frantic. 3. Swing trader, the calm strategist. If scalping and day trading feel too fast, meet the swing trader, someone who holds trades for days or weeks. Typical time frame: 4 hour. Daily, D1. Weekly charts. Trade duration: several days to weeks. Trading frequency: 2 to 10 trades per month. Goal: catch bigger market swings, trends, reversals, and momentum waves. You should be a swing trader if you have a busy job or school. You can hold positions without panicking. You prefer deep analysis over fast reactions. You want high reward to risk ratios. Challenges: requires patience. Overnight gaps can hit stop losses. Markets may move slowly during consolidation. Swing trading is like long distance running: steady, calm, and strategic. 4. Investor, the long-term builder. Finally, the investor, someone who buys assets to hold for months or years. Typical time frame: weekly, monthly, quarterly charts. Holding duration: years, sometimes decades. Trading frequency: very low, maybe a few decisions per year. Goal: grow wealth slowly and steadily through stocks, bonds, ETFs, crypto, real estate. You should be an investor if you think long-term. You don't want daily chart watching. You prefer compounding growth. You're focused on wealth building, not quick profits. Challenges: requires patience. Market crashes can test emotions. Slow results. Investing is a marathon: slow, disciplined, steady, and life-changing. How to choose your type. To pick the right style, ask yourself these questions. How much time can I spend trading daily? How well do I handle pressure? Do I prefer fast or slow decisions? How patient am I with my money? Do I want quick income or long-term growth? Your personality determines your trading success more than the strategy itself. So, are you a scalper, day trader, swing trader, or investor? If you found this video helpful, give it a like, subscribe, and share it with someone learning to trade.